This is Matthew Cratter from Bitcoin University, and today I wanted to talk about the dilemma that's faced by the Federal Reserve and the world's other major central banks. I'm calling this high inflation or insolvent banks. And in order to understand this story, we need to rewind and remember how in 2020 and 2021, the US government issued about $5 trillion in debt to issue stimmy checks and to basically fund the economy during the lockdowns. And what they did is the central bank itself, the Fed, bought a lot of this government debt, and it also stuffed the banks and the insurance companies full to the gills with this government debt, which is called US Treasuries, as well as other forms of debt like mortgage-backed securities, which are really baskets of residential mortgages for the most part. And what they did is the central bankers told the commercial banks, that it was safe to invest because they were going to keep rates low for a very low period of time. There's the famous quote from June of 2020 where Powell, this actually doesn't even go far enough, he said, we're not even thinking about raising rates. He also said even a year later, he was saying that high inflation is temporary and that the Fed would be very patient. So this encouraged a lot of banks and insurance companies and pensions, etc., to load up on U.S. government debt, even at very low rates, where it was yielding 2, 3, 4%, depending where you were on the curve, and put this on their balance sheets with the assurance from the Fed that they wouldn't be raising rates anytime soon. Now, what happened is the Fed actually went on. They panicked. There was inflation. They panicked and they raised rates at the fastest rate, I think in approximately 80 years or so, beginning in early 2022. And they blew up a lot of things in the process, taking Fed funds basically from 0% up to 5%. So the Fed panicked, interest rates went up, which meant bond prices went down. And all of a sudden you had these US banks, which had been reassured that everything was going to be okay. They were sitting on losses of 20, 30, 40% on their US Treasury and mortgage-backed portfolios. So this wasn't just mismanagement by the banks. There was some mismanagement. For example, Silicon Valley Bank, they tried to get a little higher yield and they ended up collapsing their entire bank because they bought long-dated, long-duration mortgage-backed securities whose price went down quite a bit when the Fed hiked. So this resulted in a lot of bank failures. Basically, the Fed reassuring banks they could load up on these things and then blowing up the banks by raising interest rates. And this is something that is continuing today because of Fed policy. So if we take a look at some of the too big to fail banks, like Bank of America, they still offer very low yields. So here's an example from the Bank of America Advantage Savings Account. You still are earning only 1 basis point. So that's 1/100th of a percentage point. Now, by contrast, if you want to fund the US government instead and own T-bills or own a money market account, which is sort of similar in terms of what they invest in, the yield is about 5%. So you have a choice of 0% or usually less than 1% on these big banks, or 5%. So what we're seeing as a result of this is money is leaving these bank savings accounts and it's going into T-bills directly. It's also going into money market funds and money market accounts. And so this is the paradox. The more the Fed hikes rates, the more it is encouraging people to flee the US banking system, pull their money out of their savings and checkings accounts, and put it into higher yielding accounts, which are basically funding US government spending. They're investing in T-bills. And this is one way in which US government borrowing is crowding out the private sector and the banking sector as well. So the Fed hiking, trying to slow down inflation, has this perverse effect of blowing up the US banking system and causing these capital flights from the banking system into government debt. So the question might be, why don't banks just offer higher interest rates to try to keep their customers? The problem is it's impossible to compete with these T-bills at 5%. It's impossible to offer a 5% savings account interest rate to match these T-bills yield when your legacy mortgage portfolio and your treasury portfolio is earning 3.5% and is down 20 to 40% in price because you bought these treasuries and mortgage backs in 2020 and 2021 before the Fed hiked rates and blew up your balance sheet. So these banks have a choice. They can either dump their portfolio at a loss and then try to raise savings account interest rates to keep depositors. But then they have this problem going forward. First of all, it looks really bad to realize these losses. They have to report it to investors. But they have the additional problem of how are they going to make money going forward when the yield curve is still highly inverted, which means that short-term rates are higher than long-term rates. And this really blows up the whole business model. Banks' basic business model is to lend out, is to borrow short and lend out long. So for example, they'll pay you 1% on your savings account and then earn 4% by lending out your money to someone who wants to buy a house by issuing a mortgage. And they make this 300 basis point, this 3% positive spread, and then they can lever that up. That's the basic bank business model. But this business model breaks down when the yield curve is inverted, as it is. And we can see here, even with U.S. Treasury rates, the short-term 1 and 2 month T-bills are above 5%, and then as you go out, you end up being below 4% for some of the more long-dated Treasuries. So this is what an inverted yield curve looks like. We can look at the yields on the 10-year note, which are below the yields on the 2-year note. This measures the 2s10 spread, and it's highly negative, more than 102 basis points. It's very, very rare for the U.S. yield curve to get this inverted, and as we said, it causes a lot of problems for the banks. So ultimately, the Fed's going to need to choose between letting inflation run hot and saving the banking system. As we've seen from this demonstration, the global banking system may just be too fragile to withstand the high interest rates that are necessary to slow inflation. And it's a bizarre problem because this inflation itself was caused by central banks printing too much money. Now they're trying to rein it in with higher interest rates. But this contrast there, or this paradox that the Fed is going to have to choose between letting inflation run hot and not blowing up the banking system, even the IMF has figured this out by now. I think this was a very significant article from the past few days. IMF warned central banks of uncomfortable truth in inflation fight. And this was a speech by Gopinath here, who's the deputy head of the IMF. And she basically said that central banks must accept the uncomfortable truth that they may have to tolerate a longer period of inflation above their 2% target in order to avert a financial crisis. And this is what she's referring to, how these high interest rates have the potential to completely continue to blow up the banking system. I'll link to this article in the description notes below. So what's going to happen going forward? Basically, the smaller banks, the regional and mid-sized banks, are going to continue to see capital outflows, both as depositors flee low savings rates and move into T-bills and money markets, and as depositors fear that these banks are going to blow up. It becomes a self-fulfilling prophecy, and so people move their money out of these banks, thus accelerating the bank's decline. They move their money into too big to fail banks, which are basically backed by the U.S. government and the Fed explicitly. And what this means is that we're going to see more bank failures coming for small banks unless the Fed were to reverse course, stop hiking, and maybe even cut rates and try to get the yield curve looking normal again, where short-term rates are below long-term rates. Now, we're going to see continued inflows both into T-bills and into these too big to fail banks, and they will continue to take market share. This is what we've seen over the past year. What I've done here is I've put all of the too big to fail banks like Bank of America, Goldman Sachs, Citigroup, Wells Fargo, Morgan Stanley, etc. Those are these colored lines at the top, and we can see that they've actually really quite outperformed everything else over the past year. And then if we take a look at the orange line down here, this is the regional banking index. The KRE is the ETF for this, down 28%. So we can see this huge spread between the too big to fail banks that are seeing capital inflows and the regional banks, which are in the process of blowing up. This chart doesn't really tell you how bad things are, because if you were in a regional bank like Silicon Valley Bank, you've basically, your stock price has gone to zero. So the index masks this to a certain extent. So what's the only problem with these big inflows into the too big to fail banks? The problem is these are backstopped by the central banks and their money printers. And the problem here is that the central banks have been so aggressive in raising rates that the central banks themselves are beginning to fail. We saw this earlier this week, where the German audit office reported that the Bundesbank, which is the central bank just for Germany, not the ECB, but just for Germany, is basically bankrupt. It may need, this is the nice way of saying it, it may need recapitalization to cover bond buying losses. So the central banks did the same things as the too big to fail banks and the regional banks and the mid-sized banks. They loaded up on government debt, which then imploded. And there's a good argument to be made, which Lynn Alden makes in this essay, which is quite good, about how the Fed itself is insolvent, and they're basically paying out more interest than they're earning on their portfolio, and this has the result of eating away at their equity. So I'll link to that in the description notes below. The real question is who's going to bail out the bailouters? Who's going to bail out the central banks? And the problem is it's ultimately going to be us. It's going to be the taxpayers, either directly through taxes or through inflation caused by money printing, where the banks basically bail themselves out through money printing. This is the problem with the fiat clown world, because basically your productivity and life force are siphoned off to pay the bankers, the commercial bankers, the investment bankers, and the central bankers, both in good times and in bad times. They make a lot of money in good times, and in bad times, the taxpayer ends up with the holding the bill. This is basically what I've called before privatizing the profits and socializing the losses, which since the great financial crisis of 2008 and 2009 has really become global policy. And it's another way that bankers ruin our lives. Fortunately, we have Bitcoin. Bitcoin fixes this. And as we move, I think all this chaos actually will help to transition us more quickly to a Bitcoin standard, where these central bankers don't have the hubris to think that they can make the right decisions for the 8 billion human beings who live on the planet. If you enjoyed this video, be sure to hit that subscribe and like buttons. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks all for watching, and I'll see you in the next video.